do is identify the type of audit test. So if you remember, the types of audit tests that we have are test of controls and substantive tests. And within substantive tests, we have three types of substantive tests. Test of transactions, substantive test of account balances, and analytical procedures, right? So those are the three types of substantive tests that an auditor can perform. So what this problem is asking you to do is identify the type of audit test it is and the assertion that's satisfied by that audit procedure. So a dual purpose test represents a test that by performing that audit procedure, you're actually gathering information or evidence about the effectiveness of the internal control, whether or not the control is working, so you're testing the control. And you also gather information about the transaction dollar amount, so the amount. So you have information about what's reported in the financial statements. Okay, so for example, the first audit test is vouch recorded sales invoices to supporting shipping documents, right? So you're taking a sample of invoices recorded in the sales journal and you're vouching those to the shipping documents. Why? Why are we performing that audit test? Well, occurrence, but what does that tell us? What do we know when we perform that audit test? What will we have evidence about? Well, revenue, yeah. But what about revenue? That, okay, occurred, right? Because we're talking about transactions, right? So they occurred. So the revenue occurred, the sale occurred because we have a shipping document, right? The shipping document in this example is how we determine that the revenue should be recorded. So by performing this audit test, you now have information about controls around recording sales, right? Because the sales should only be recorded when there's evidence to that sale actually occurred, which in this case is the shipping document. So a control would be that amounts recorded in the sales journal are supported by a shipping document. That's the control. That test provides evidence of that. And it also provides evidence that the sale occurred. So it provides evidence about the amount that's reported in the revenue account. So that's called a dual purpose test. So when you're looking at an audit procedure, you have to ask yourself, what will I know when I perform this audit procedure? What will I have evidence about? Okay? So let's take some time to do working groups next to your seat mate and address the C through M, I believe. All right, so for B, inspecting the recorded sales invoice for credit approval. When you perform that test, what will you know? What evidence will you have? Inspect the sales invoice for credit. Okay, so you test what okay. So you test the control and the assertion is accuracy. So you'll know what though. So you'll know it's accurate, be more specific. Try to be a little bit more specific.
I don't know, it's before that the knowledge
Okay. So why are we testing? Why do we care about credit reporting? Why is that important? Right, so that customers are able, that you're selling to customers who are able to pay back, right? You want to sell to credit-worthy customers because once you sell them goods, your goods are out the door. If you don't get paid, you've lost an asset. That's a loss. So you want to see that they're a good control. Credit authorization is to see to ensure that you're only selling to credit-worthy customers, and there are controls around that. Right. So, but selling to credit-worthy customers, what does that mitigate? By having that control in place, what does it mitigate? How does it protect you as a, well, not the auditor, the auditor, right, this is the company, right? So as an auditor, it doesn't affect me if you sell to bad customers. Possibly, but be a bit more specific. So why do we issue credit? Because we want to sell to credit-worthy customers, and why is that important from a business risk perspective? Right. So, well, not so much that, but you're on the right track, Casey. Not so much that they have accurate amounts without the accounts. It mitigates a bad debt, right? So it mitigates the chances that the company will have to write off that receivable or will not be able to collect on that receivable, and that impacts valuation. So the valuation, you also gather some information about valuation. Well, it impacts the valuation assertion. So the accuracy is the correct answer. The solution also says occur. That it gives you because the reason the solution also says occurrence is because then if you know you're selling to credit-worthy customers, it gives you information about the collectability or potentially around the collectability of amounts reported in the revenue account. And it also tells you information about the amounts that you're selling to approved customers. So think about one of the way we describe occurrence is that you're selling, that the sales were made to non-fictitious customers, right? Valid sales to non-fictitious customers. So that gives you some indirect information about what is reported in the revenue account, the amounts that are reported in the revenue account. They're valid, and they're made to valid customers. So that would make it a dual-purpose test. I'm sorry, not a dual-purpose test. It's a test that controls, but it gives you some information about occurrence as well as valuation. So test the controls. What about the third one? Vouch the recorded sales invoice prices to the approved prices. So you're going from the sales invoice to the approved prices. What will you know once you perform that number test? What are you looking for? What's the objective? Somebody other than Casey? It's a good way to practice for the exam. Throw it out there so that way if you're wrong, we can correct it, right? You won't make the wrong answer on the exam. Yeah.
Well, this is actually something that we kind of did in that other case that you had proposed to us to make sure that, going back into like knowing your industry and research that you have to do so that certain industries you're not going to have discounts, so the pricing shouldn't be different from like this Whole Foods to that Whole Foods.
Right, so because it's an approved price list, right? That's what you're doing. It's the client's price list. So you want to make sure that they're charging the right prices, right? In accordance with the company's prices. If they're not, there are controls around that. So what kind of test is that?
Accuracy? Oh,
That
no.
type of test. You're telling me the assertion. You're absolutely right. The assertion is accuracy. What type of test is it? We have test of control, substantive test of transactions, substantive test of account procedures, and analytical procedures.
Test the control?
Yes. Right? The only thing you're going to know by testing, you have no idea about the amount that's recorded and whether the amount recorded in the revenue account. What you do know is that the prices being charged to customers agree to the price list. Right? That's a test of control. So you know that that control is effective. Sending confirmations to all customers regarding accounts receivable. What type of test is that?
beginning.
Okay, how many people did this? How many people worked on the problem? Okay, so the people who worked on the problem, could you at least respond? I don't want Casey and Anna and Stella to be the only people responding. You're sending cash, you're sending confirmations to accounts, for accounts receivable. What's the objective of doing that? Yes.
To find out whether it actually
But accounts receivable is what type of balance? Is it in the income statement or balance sheet? So that would make it an assertion about account balances. So let's think about it. So I sent a confirmation. So completeness tells me what? If the assertion about completeness says what? What is management asserting when they say completeness? Everything that should there. So will sending a confirmation tell you that everything that should be recorded is actually recorded? No, right? That's how you have to think about these audit procedures. I'm making this a long, drawn-out process because I want you to get 100% on the exam, okay? So it doesn't tell you, so that completeness is important, but that procedure will not tell you about completeness, right? Because by sending out the confirmation, you don't know that everything's there. Why? Because when you send out the confirmation, you're sending out the confirmation based on what the client has recorded. So you're only going to be able to send out confirmations to what they have recorded already. That doesn't tell you that if they forgot to report something, you never send that confirmation out. You have no way of knowing that, right? So let's go back. So it's not completeness. Existence. That's what, when you say, so trigger. If I say confirmation, you think existence. Like that's what that procedure gives you. It tells you that the account exists. Right? It doesn't tell you if the account is right, the amount recorded is right. It just tells you that that account exists. It's a way to determine if the amount that's recorded is correct, but it tells you that it exists. So you're going from the accounts receivable subledger, the detailed accounts receivable ledger, and you're selecting a sample of accounts to confirm, and you want to confirm that those accounts exist as of the balance sheet date. Yes.
Sending out positive confirmations, would that give you also information about the value or
Well, you will get information about the accuracy, but that is not the primary test, right? So yes, if you confirm that, if you send out a confirmation and the client has the balance listed as $100,000, but then the confirmation comes back and say, yes, we owe them money, but we only owe them $75,000. Then you have to follow up and see what the problem is, right? Why is there a difference? It could be a timing difference. Or they'll come back and say, yes, we owe them $100,000. All right, so what type of test is that?
That's the control.
You're testing what control? By sending out a confirmation, what control? What do you know about control? It's substantive, right? That's the only thing you know. Because what's the control, right, with the confirmation? It doesn't tell you anything about controls. Most of the controls you're going to see around that will be controls around the transactions itself, which is why you tend to see that when a dual purpose test usually involves test of controls and test of transactions, right? Because that transaction resulted in an accounts receivable, right? And you usually test the controls around that. So that's a substantive test of account balance, because we're talking about accounts receivable. Okay. How about F? Compare the shipment date of the recorded sales invoice with the invoice record date. Shipment date to the invoice date. Yes. And what type of test is it? It's a dual purpose test, right? So you're testing by performing a cutoff. You're not only testing at the control, because the control again is that the shipment, the shipment is what results in you reporting revenue, right? So you're testing that the dates on the shipping document match the dates on the sales invoice. So like sales invoice dates match the shipping document date. That's the control you're going to see. That they're recording it in the correct period. And you also get information about what's recorded in the revenue account, about the dollar amount of what's recorded in the revenue account, because you're testing again cutoff, so that you know that the amounts that are recorded in the correct period and so you have information about the revenue account that is reported, that the revenue account reflects transactions that happen on or before 12/31 or the year end date. So it's a dual purpose test because you can gather information about the controls as well as about what's recorded in the revenue account in this case, and its accuracy. I'm sorry, cutoff and complete. How about, what about H? Select a sample of shipping documents from the shipping department and trace those shipments back to reported sales invoices or sales journal. Going from the shipping document to the sales journal. Yes, and
Is there a test of control related to completeness?
yes. So it's completeness, but don't you also know information about what is completeness? Everything that should be recorded has been recorded, so that also gives us information about what's recorded in the revenue. So it gives you information about controls as well as about what's recorded in the revenue account. By performing that test, you know that everything that should be recorded has been recorded. All right. Vouch the sales invoices and shipping documents. Sales invoices and shipping documents. You're vouching. What will you know? What's the objective? So your objective is to gather evidence about whether or not the sale is a valid sale. So that's occurrence. What type of test is that? Yes, you would be figuring it correctly. Dual purpose test. Because you're testing the controls around the recording of revenue, and you also know, because you're gathering information about occurrence, that the sale occurred. It's a valid sale. So you have information about what's in the recording. Evaluate the adequacy of the allowance for doubtful account. The adequacy of the allowance for doubtful account. Exactly, that's the assertion, is valuation, because you're talking about the allowance for doubtful account. And what type of test is it? Substantive, yeah, the substantive test of account balance. What about the next one? Obtain financial statements or credit reports or large past due accounts and inquire of the credit manager about collections. What do you think? That's good.
Would that be substantive?
Exactly. Substantive test of account balance, and what's the assertion? What are we talking about?
Whether the accounts are valued properly.
Exactly. So then, valuation. If we're talking about credit sales, evaluating customers for outstanding balances, what our concern is the collectability of accounts receivable. And so that deals with valuation. What about the last one? of the allowance for doubtful accounts using prior year relations of write-offs and sales. Okay. Right. This is a standard test, in this case, an analytical procedure. And what are you testing? What's the assertion? Gathering evidence about what assertion? Valuation. So, hint. If I say something, if you see a test that involves the valuation of allowance or allowance for doubtful accounts, at least with respect to the sales and collection cycle, credit, reviewing credit, then you're talking about valuation. That's the assertion, because the objective is with those tests is to determine the collectability of accounts receivable. Right? Determine the adequacy of the allowance for doubtful account. That deals with valuation. Okay. So I'm going to post this question, post assertions and trust controls. These are going to be extremely important, so you want to make sure that you can answer these questions and you understand the answers that we arrived at, because I will test you on this on the exam. So you have to be able to understand. And the key here is why I wanted to do this problem is to be able to understand. If you read an audit procedure, you have to understand what the objective of that audit procedure is. When you perform that audit procedure, what will you have evidence about? Remember, we're in the evidence gathering stage now. Everything that we're doing now is what auditors do to gather evidence about assertions that management makes, about the amounts that are reported in the financial statements. So that evidence, remember, has to be persuasive, it has to be reliable, it has to be relevant. So you have to think about, well, what will I know when I perform this test? What's the objective? Let's look at another problem. So let's look at problem 764. Which is on page, it starts on page 308, carries over to 309. So it relates to audit objectives and procedures for accounts receivable. So, B, the client company has legal right to all accounts receivable at the balance sheet date. So what assertion is that? Rights and obligations. So how would the auditor gather evidence? Read it.
Review loan agreement for indication of whether account receivable have been factored.
Yeah, right. So that's good, because that means what you're looking for again is if the client has factored the accounts receivable, they no longer have the right to collect the cash from that accounts receivable, right? That's owed to a third party. And normally those types of agreements, you would have a contract for that or some type of legal agreement, and also it might be indicated in the board of directors minutes. So 5 would be the best procedure for that. What about accounts receivable are stated at net realizable value? That's what assertion? Valuation, exactly. So how would you test for that? How would you test it? Gather evidence about valuation. Tell me the procedure. Read it for me.
Review the age, trial balance for significant custody accounts.
Exactly. Right? So you're going to look at the age trial balance. And then the last is accounts receivable are properly described and presented in the financial statements. Right. Presentation of disclosure, and how would you gather evidence? What would the auditor do? What procedure fits best? Right, that'll provide some evidence. Another procedure as well. So what's our concern? What should be in accounts receivable? What types of receivables? Well, yeah, sales, but sales to what type? Trade, right? So trade accounts receivable should only reflect sales made to customers. So the auditor's concern would be, we want to gather evidence that is the only thing that's reflected in accounts receivable.
6, review the account receivable, balance receivable, opportunity.
Right, that's procedure number 6. You want to make sure that there's nothing in the accounts, the trade account receivable balance that represents accounts receivable from other third parties or officers and directors or employees. So that would be the best procedure. Okay? All right, so let's do one more problem. Problem 60, part B only. So what you see, the exhibit 7.60-1, you have a number of errors at the top, and then you have control procedures going down the rows. You want to identify what control procedures would prevent those errors, or control procedures designed to prevent those errors or detect those errors prevent them from occurring or detect them on a timely basis if they do occur. So match the error with the control procedure. And you could have multiple control procedures. And a control procedure could be used more than once.
Okay, so it's like cross and X's without the cross. I can't read that. Okay. Why is it not registered? Yours are grounded.
So for the very first sales order approved for credit, what's the error here that we're concerned about? What error does this control address or mitigate that? What do you care about? What's the concern? Yeah, paid to bad credit customers. So by ensuring that by having a control that sales orders are approved for credit, right, then you're not, you're avoiding or mitigating the chances that you sell to a customer bad credit. So that's accuracy, or that goods are shipped to a customer bad credit. So that's the error, right? Because if you remember, the sales order is what the customer sends in or calls in, right? That's what the customer initiates. So before you process that sales order, you should check credit. And if you determine that the customer doesn't have good credit, then you shouldn't process the shipment, right? Or process the sales order. So it's C. What about pre-numbered shipping docs prepared and the sequence checked? Pre-numbered documents. Why do we care about pre-numbered documents? What's the objective? Yes, it's complete. Right, so that would be B, right? Good ship, sales not reported. Right, we're talking about shipping documents. So that control addressed that, and it also gives you some information about occurrence, right? Because you have the shipping document, and so the shipping document is evidence that the sale should be reported. What about 3? Shipping documents. Shipping document quantity compared to sales invoice.
D.
You said D. Did I hear D?
Yeah.
Yeah. Accuracy. right? Sale billed at the wrong price or the wrong quantity, that's what that prevents. What about 4? Pre-numbered sales invoices, sequence check. Was again pre-numbered. When we talk about pre-numbered, remember what I said? Completeness, right? Pre-numbered is you're dealing with the sequence, right? You're checking to ensure that all of the documents are that the documents are complete, that all of the documents can be accounted for. So what you're concerned about is that. So if you're talking about shipping documents, you want to know that all transactions that should be reported have been reported.
So could it also check the error for January sales reported in December?
Yeah, I would. That would be a good control procedure there for that, right? Because here what you're making sure they're pre-numbered and you're checking the sequence, right? You're not checking the dates to determine that at that point. Sales invoices check to sales order. You're checking the sales invoice to the sales order. You're agreeing the two.
4 was G.
No, 4 was completeness. Right. About 5. Sales invoices check to sales order. What are you concerned with here? So why don't you look at appendix 7A, number 20. So what is 7A? What's the, number 20? What's the question? Yes, accuracy. What about invoice prices compared to approved price list? Right, so accuracy, sales billed at the wrong price or wrong quantity. Okay, what about, still not gonna do all of these, so, number 9, periodic sales total compared to same period accounts receivable postings. That would not, that doesn't provide you with enough detail to determine, because G deals with cutoff.
You said 7?
Number 9, periodic sales totals compared to same period accounts receivable postings. You're comparing sales amounts to what's reported in the accounts receivable. What's the relationship between sales and accounts receivable? Hmm? Why do we have accounts receivable?
Sales occurred.
Because of sales, you generated a sale to a customer on credit. So, F. Right? That's the only thing that what you're trying to make sure of is that you're posting charges, right? Because when you invoice your customer, that's your charging it. Right? So, and when you invoice your customer, that invoice should update accounts receivable. So you ship, generate an invoice, debit accounts receivable, credit sales. So you're right. Completeness. Right? And it's F. Failure to post charges to customers for sales. What about 11? Sales entry date compared to shipping document date. The date that you recorded the sale in the sales journal agrees to the date that you shipped. G, dates. So sometimes when I'm comparing dates, my concern is cutoff. I want to make sure that it's recorded in the appropriate period. So the answer would be G. January sales reported in December would be wrong. So that would be that cutoff was it was reported in the wrong period. 14. Credit files are updated for customer payment history. C. Right? Accuracy. You're concerned about customers with a bad credit history. You don't want to sell to customers with a bad credit. You don't want to ship goods to a bad credit risk customer. So you want to ensure that you're always updated, that the credit files are updated on a timely basis. So you want to make sure that if before you ship to a customer, if they already owe you money, right, and they're not paying you, if there's evidence that that customer is late in paying you, you don't want to continue to ship them goods, right? So that deals with accuracy, good ship to a bad credit risk customer. So that would mitigate that. That's a control that would be important to mitigate that error. All right. So any questions on? And I'll post the responses, the solutions to these problems, which is going to be as well as additional practice problems, because it's going to be important. So when you think about assertions, when you think about the audit test, what will you know by performing a particular audit test? What's the objective? That's the importance of the assertion. Remember what we talked about when we talked about assertions initially. Assertions are what management makes about the amounts that are recorded in the financial statements. Auditors gather evidence around those assertions. So the assertions basically is a framework for the audit test that auditors will perform, right? They're going to gather evidence about the assertions that management's making. So you have to think about, when I perform an audit procedure, what will I know? What does it tell me? Okay, so just some housekeeping. You know your case. So by now, everyone should have had the meeting with their counterpart in Seattle. You know that you have to upload that information. Someone emailed me that they were having a problem.
Yeah, I don't see a place to.
And I don't know what, so I have to call. I have no idea why it's showing up on my end, so I'm not sure why. So I have to get somebody from tech to take a look, tell me what I did wrong. I'm not sure why. So I'm trying to make sure I can resolve that before Thursday. Worst case, you just submit it to me via email. The other thing is, there's some group, I'm going to send an email to certain groups who haven't presented yet, with you'll present this case, or at least your group's approach to resolving it, and I'll tell you exactly what I want you to discuss in your presentation. So look for that either today or tomorrow. And that's it. So make sure that you read